Hi, I'm Tom Selzer from Livewire Markets, and after a long period of record low interest rates, investors and savers have enjoyed better returns over the last couple of years, but that could be about to change. To discuss where rates go next and where investors can find better income opportunities, I'm joined by Cameron Gleeson from Betashares. Thanks for being here.
Thanks for having me.
Obviously, the markets are expecting a couple of RBA rate cuts this year, with the first one likely later this month. What are you expecting?
Yeah, that's right. So we're early May right now. The first rate cut priced in for later this month, with further cuts in the second half of this year, so 3 in total. Our view has been for some time that we'll have 3 rate cuts this year. We think that was confirmed by CPI moving within the RBA's target band, and a cut as an insurance policy, given global instabilities, probably worthwhile at this stage. And we think that 3 is probably about the right number so far this year.
Yeah. And if rates do drop, where do you think investors should be looking for better income generation?
Yeah, I think that's interesting, because if we look at the period before the pandemic, when rates came down to near zero, a lot of Australians were looking to the equity side of their portfolio to generate income through dividends and franking credits. The yields on the ASX 200 have been really eroded away over time, particularly through reduction in dividends from the material stocks. And so term deposits have been making up a large part of where Australian investors have been looking for yield, as well as fixed income in terms of bonds. I think this will be really interesting as to where we move forward from here. If dividend yields are lower and if cash rates are falling, where am I going to go? So obviously, you can look for things like hybrids, which are currently yielding around about 6% for big bank hybrids, but that will be falling over time with cash rate changes. Otherwise, there are other parts of fixed income you can look for, like corporate credit, so high quality investment grade corporate bonds, Australian corporate bonds, yielding around about 5.5%. Fixed rate bonds in a falling rate environment can make a lot of sense for making up the overall yield objective of your portfolio.
I mean, you mentioned it there. It's obviously been a pretty interesting time in bonds recently as well. Yeah. What are the trends you've noticed, here in Australia?
Fixed income in Australia is actually in quite a good space. We think that, Australian government bonds are quite well priced. They're giving good compensation and good diversification for investors. We think that the risks are skewed on the upside there in terms of outcomes. And we also think that Australian corporate credit is quite well priced. Australian corporate credit tends to be very high quality, very low levels of volatility in terms of corporate credit in Australia. So still a really good asset class and good compensation for the risks you do take on by backing corporates.
So Betashares have just launched a new range of defined income ETFs. Can you just give us a quick overview?
Yeah, look, I think these are going to be a really exciting range of ETFs, the defined income ETFs. The way I describe them is they give you a lot of the features and characteristics of investing in a bond, but with all the advantages of an ETF. Now, if we think about what investing in a corporate bond looks like, on day one, you'll pay your notional dollar for that bond, and that might be $100. You'll receive fixed coupons of perhaps $5 per annum, and at maturity, ideally, you'll receive your $100 back. Now, that can be a really attractive return proposition, and for a lot of investors, the certainty of the ability to receive the $100 back at maturity, provided all goes well, is really attractive. Now, what these 3 ETFs do, and I'll go through the names, but they really look to package up a portfolio of bonds and hold those bonds to maturity. So rather than holding a single bond, you've got the benefits of diversification. Now, the first one of these ETFs is 28BB, which is the Betashares 2028 Fixed Term Corporate Bond Active ETF. Now, this ETF will hold a portfolio of bonds that are all due to mature in early 2028. And the ETF itself will mature. And what the investor experience will be, they put their capital in on day one. The ETF targets a dollar amount of distribution of cash to investors every month, the same dollar amount. And at maturity, they'll receive their final cash back. Now, it's quite an interesting investment proposition for investors. Typically, ETFs will have that ability to go on forever. This ETF is really looking to replicate a lot of the experience of buying and holding a bond to maturity, but benefiting from the maturity of holding the basket of bonds and using the scale and institutional power of an ETF provider to deliver that in a low-cost manner to investors. So there are 3 ETFs to start with. 28BB, the first one that I just mentioned. We have 29BB maturing in 2029 and 30BB maturing in 2030. We think these are going to be a really exciting product range for investors. Already seen a lot of interest in what they might provide.
I think you've touched on the reason for it there, but why now? Why are you launching these products?
Yeah, so I think what we've seen is, I mean, we can look at the US. These types of ETFs in the States have really taken off. So there's over $50 billion in ETFs in the States that provide this sort of investment profile, and they've been really successful. If we look in Australia, around about August last year, we started to see the big banks cutting their rates on term deposits. Not so much a 1-year term deposit, but a 3 and a 5-year term deposit. Obviously, sort of as a precursor to cash rate cuts coming, they're going to lower the amount of return that investors were getting on term deposits. And what we've seen is really a desire for capital stability together with good compensation, a good income. And that's really sort of the genesis, is that demand for a very defensive asset with that certainty in terms of return profile and ideally what you're going to receive at maturity. And I think what we've seen in the initial weeks has been real appetite and interest in these funds as a result.
Yeah, you're touching on the interest there, but why should an investor go with one of these ETFs instead of investing directly in bonds?
To really execute efficiently in the bond market, it's an over-the-counter market. It's a very institutionalized market. Depending on what exchange you execute on, you may need to trade in size of over $500,000 in a single trade in order to buy and sell bonds. And that creates a lot of problems in terms of diversification. Diversification is one of the free lunches that's available. It's unlikely that many investors will be able to build a well-diversified portfolio. But I did say there are platforms that have enabled mum and dad investors to access bonds in a direct or slightly packaged form. Often the transaction costs, frictions, and if you like, the market making can be quite costly. And I guess retail investors are at somewhat of a disadvantage when they're trying to participate indirectly. And I guess the really good thing about ETFs is that democratization of finance and really providing that access through institutional scale, but packaged through a very low cost ETF. I think it's really one of the great things about ETFs is that ability for everyone to participate in markets they maybe weren't able to before.
Yeah, fair enough. And what would you say then on the other side, the risks of going with a defined income ETF, especially compared to something like a term deposit, which people are familiar with? It seems very safe. You know what you're going to get with something like that.
Yeah, that's right.
This is a new, it's a pretty new product. Why would you choose this?
With the defined income ETFs, obviously we have that target objective of the same dollar monthly income every month. You receive your capital back at maturity. It's a lot like a term deposit, but we should note there are significant differences and risks to consider and trade-offs. So term deposits are obviously a bank deposit, so they're very highly rated. We also have a government guarantee, where if you hold up to $250,000 in a bank account, the government will guarantee that money if the bank was to fail. So there is certainly a high degree of safety in holding cash in a bank. Now, with that comes also, an interest rate which perhaps isn't as attractive as you can find elsewhere. If you look at Big Four bank term deposits right now, today where we're sitting, they sort of range between 2.8 to 3.4% for a 3 to 5-year term deposit. Now, these ETFs, they're holding high quality investment grade bonds, and let's say, for example, the 30BB, which is that 5-year ETF that's going to mature in 5 years' time. It's got a yield of just over 4.5% after fees. So, if you're looking at sort of pickup of yield versus the potential risks around the ETF, that makes, for some people, the ETF perhaps a really attractive proposition. But also, if we think about one of those other advantages of ETF that I mentioned earlier, it's liquidity, of course. So term deposits, or for example, term annuities, very difficult to break, whereas an ETF allows you, if you want to trade out to basically redeploy that capital into markets, or if for some reason you need the cash, for whatever reason, you can exit at any time. So it's that sort of combination of advantages of that flexibility of the ETF together with the additional yield that it does allow versus some other alternatives that I think means that it's really resonating well with Australian investors.
You said the feedback, the interest so far has been pretty promising. What are you hearing, from investors about these ETFs?
It's really quite novel, the fact that we have an ETF with an end date, and I think that alone is something which is really picketing interest. So this ETF is going to end at that point in time. Our intention is to list new ETFs as we go along. So it's really, if we think about the 3 ETFs available, what time frame do I want to lock up my money for? When am I going to need my cash? you can use these as a series and decide when you need that cash and what interest rate looks more attractive or what yield looks more attractive to you. So it's really putting, I guess, a lot of power in the hands of the end investor and flexibility as to how they want to manage their money.
Thanks for joining us.
Thanks very much, Tom.
Thanks for tuning in. If you enjoyed this video, make sure to subscribe to Livewire's YouTube channel for even more content. Thank you.